Thanks. We're going to kind of conduct this as a fireside chat format, and where there's a couple of questions that I will discuss with Swaroop. But I would first like to say that this entire area of ESG, environmental social governance, is of critical importance to BAFT. I myself came from a background with the World Bank, the International Finance Corporation, and the framework that many institutions use in terms of ESG are kind of formulated by the development banks. So whether it's the World Bank, the Asia Development Bank, the Africa Development Bank, the Inter-American Development Bank, there's a robust framework that's in place in terms of development. But what we've seen in the last number of years is that this framework is creeping into daily usage by banks, and it's actually creating an area of opportunity, but also extreme challenge. When we had our trade finance conference in Houston the first week in December, in one of the question and answer periods, when it was asked, what is the number one challenge you see going forward in area of greatest uncertainty for your bank, ESG came out as number one. And that's not surprising. Just as we saw in the past that compliance created a whole new opportunity for hiring and job advancement, this area of ESG is also seeing that type of growth. Just look at the number of consulting firms that are popping up around the world that now profess to be experts in the area. I think one of the difficulties we have is that there's no common framework for definitions or what that framework looks like and exactly what is being asked to report. And I'm hoping in our session today with HSBC and Swaroop that they've got a well-established practice, and hopefully this is an opportunity for all of us to kind of learn as we go along. I would like to ask Swaroop as a first question. First of all, welcome, and thank you for participating. I'd like to ask, what are the biggest challenges and opportunities in global trade rising from the ESG agenda?
Well, thank you, Scott, for having me. And you've very nicely introduced the topic, that this is probably the most evolving and uncertain area for every institution, not just bank or financial institutions, but every institution in the world at this moment. And it's probably the biggest challenge of our generation that we would be facing now, or we are already facing. And trade is, of course, not untouched by this. Trade is very much at the heart of this, and that is very nicely illustrated by the fact that 80% of carbon footprint of any given supply chain actually lies in its supply chain. So, and supply chain is what trade finance services. So majority of the climate risk for any institution is actually lying in its supply chain. And that amplifies the importance of addressing this challenge upfront by trade financiers and putting this at the center of the agenda. The flip side of this is that while the challenge is acknowledged, there is no real solution that anybody has come around this, simply because the challenge is so fragmented. It's not just about large institutions, it's not just about suppliers in some developing countries, or it's not about service providers. It needs an integrated, multifaceted solution for the challenge to be addressed. And that is where the problem lies. Quite often we have solved challenges of the past by developing new technologies, by implementing new solutions, by bringing new products to the market. But ESG is not about bringing new product or services to the market. ESG is about innovating, reconfiguring, and collaborating between institutions. And that's going to be the biggest challenge for trade finance as well. The other big area which is both a challenge and opportunity is the cost and the technology aspect of it, to balance between developed and developing worlds, to be able to address these challenges in a cost-effective way, in a way that it's accessible for SMEs and developing markets, is the other big challenge for trade, because the suppliers of the world have to transition for the buyers of the world to transition themselves. it is not, no one is in isolation in this, and we have to take everybody along. And finally, I would say the last challenge, which is around this, is to balance all the three pillars. So quite often there is overemphasis on E, and E is referring to climate emergency and green broadly. But there is also this aspect of S and G that needs to be balanced, while we can't solve for one and create another problem. So there is need for us to balance E and S and address the G part as we go along. Sorry, Scott, you're on mute.
Technology challenge. Okay, well, what are the key enablers for required for trade to be a force for good and catalyst for global transition?
So, like I said, some of these things are very, very well known. And what we need to do is actually threefold. There is need for policy level intervention, and a lot of it is already happening. We have seen multilateral institutions become active players in this area over years. We have now started seeing regulatory consultation starting in different areas of ESG. But there is very clear policy direction needed for us to be able to reorient trade flows in a systematic manner. A very good example of this kind of consultation is the consultation on carbon border adjustment mechanism, for example, that's happening in European Union, where they're considering carbon border adjustment taxes or charges. And there are various views on this subject. And one may not be better than the other, but the whole point being that the thinking has to move from just having tactical solutions to having policy interventions which have widespread impact, even at the cost of immediate hardships. Another piece which you touched upon in your introductory area is definition and standardization. So currently ESG is an area where there are no standard definitions except particularly when it comes to financing, except the bond market. We haven't seen any major standardization in any other area. So there is need for us to develop and convene together to come to common standards and definitions for us to be able to do these things at scale, implement solutions at scale, both at financing, and also recognize what can be measured and reported. And the other last area is collaboration. And here, when I say collaboration, it's both public-private collaboration, so working with governments, multilaterals, and banks together, and also collaborations with fintechs, data providers, and other agencies to be able to develop integrated solutions. And this could be highlighted in example. For example, if you have to address transition risk in coffee supply chains, you need to be able to measure data on how the supply chains will move, what will be the grower technologies and high altitude growing. You also need to address soil and weather challenges in each of these countries, and therefore employ different technologies for us to be able to collect data, measure it, and then implement financing or other solutions. So it's a mix of advisory, come financing, come capacity building solutions, where all these institutions, not necessarily financiers, have to come together and implement solutions. So we need to start looking at this in a whole new way and an integrated way for end-to-end transition.
Thanks. And from a trade practitioner's point of view, what do you think are the biggest ESG opportunities that are emerging, and how can these be unlocked?
So and coming closer to, I'm hoping most of the practitioners here would like to hear about practical solutions. So while all this is good, there's a lot that can be done even today, for example, in terms of working with our clients and implementing solutions. So the first thing we all are doing, and a lot is happening within HSBC and other institutions as well, is to develop products and solutions. So developing the ESG element in your own products and solution is very important. That's something that is the first step which most institutions are doing. We have ourselves developed several products and solutions which have sustainability angle to it, and also sustainability provisions within it. The other big area is to develop transition pathways for your own institution, as well as work with your clients on their ESG agenda and ESG objectives, and link your financing and transition solutions to their objectives. And then finally, implementing solutions. Right? I would like to quote an example here, which we have implemented with a very big retailer in US, Walmart. We started on a journey with them on implementing a sustainable supply chain program with their ambition to reduce greenhouse gases in their supply chain under Project Gigaton. This was an ambition about 3.5, 4 years back now, and we worked with them on developing different KPIs with external parties, and then implemented a financing solutions which had linkage to reduction of these carbon footprint within their suppliers. Over time, this program has, of course, evolved. The KPIs, SPTs fixed with suppliers have improved. And we've also transitioned from E to S, where they are now including diversity and inclusion of their suppliers as part of their program. So this is a very good example of how an institution not only develops its ESG strategy, implements it with its suppliers on the E aspect of it, and then transitioning to S. So that's sort of a journey which every institution will now start moving on, and not just E, S, and multiple areas of E and S will come together, where there is role to work together with institutions. Or in this program as well, we have worked with external certification providers, we have worked with audit firms, we worked with the client, and not just given financing, but also help suppliers to help transition to the better future. So there are, so from a practitioner standpoint, these are type of partnerships and collaborations that we need to develop and be able to co-create solutions with our clients to develop the challenge, to address the challenge of ESG.
Thanks. And how do you think technology and data enable greater adaptation and embed ESG trade finance?
So I think technology is the biggest enabler, because all of this requires measurement. The examples that I spoke about, be it carbon footprint measurement, or be it measurement of E and S KPIs within your supplier base or network base or value chain, requires us to have better monitoring tools, be able to implement such solutions with ease, and the transparency of data and the authenticity of data has to be validated at every stage of this process. And therefore, technology has probably the biggest role to play. Now, how do these technologies come together is the biggest question, because no single institution has the capability or unified expertise to deliver this change. We all need to work together. So therefore, the interoperability of technologies and data is going to be a critical element, and being able to use this seamlessly across institutions is going to be a key element for our collective human success, because this is an area which requires us to work as a human race rather than institutions or countries, because we don't transition till the last country on this planet transitions.
Okay, thanks. And I guess we all understand that this is a development area and there are multiple industry developments. But how can each institution take steps to contribute to ESG without waiting for perfection?
So this is already a collective action that is starting, Scott. I mean, we are seeing a lot of activism across different areas of the ESG agenda. So there are a lot of non-bank institutions and NGOs, etc., who have been quite active in this space over the years. But I must say that the acknowledgement at financial industry level is quite high. We have seen that at COP26 with the Net Zero Banking Alliance, or we have seen the publications that have come out. Just earlier in the year, we published a report on transitioning supply chains for net zero alongside Boston Consulting Group. And we put out a 7-step process for how to transition supply chains for net zero within SMEs, and how to reach deeper into supply chains. Some of these initiatives highlight that there is heightened awareness in the industry, and there is need for us to now make sure that these developments are translated into action, particularly in markets where there is less resource available. So if you divide the world into Eastern and Western hemisphere, you would see a bigger divide in terms of how you want to transition from fossil fuels into greener technologies, from traditional technologies into new tech, and how do you balance employment with it. So I think there's a great need for us to balance this. But from a tactical perspective on how institutions can take steps, it's important to recognize and break down the problem into parts. We have ourselves done it as an institution and defined pathways to transition our own self and our clients. And I think every institution needs to define that to transition themselves to a cleaner, greener future, a pathway for that, and also for their own supply chain and financed emissions, for instance, in case of financing clients. And then also work with the clients on implementing these new technologies. And I gave you the Walmart example. That was a good example of how we can work with clients tactically. There are other examples in the industry. For instance, we have worked with multilaterals in one case where we have supported transition of supply chains in developing countries by risk sharing agreements with multilaterals and bringing more capacity building for the suppliers in developing countries, which helps supplier base to implement technologies, access finance, and be able to then transition themselves to newer economy solutions. Therefore, there is no one single way, but the key things I would say is rethink your product design, which is in your own hand to reorient that to ESG. Look at collaboration, look at new technology tools and how can you embed and work with existing technology and embed some of the external technology providers into your design. Develop new pathways to transition your own self and the clients. And finally, work collaboratively over time to co-create solutions. I think these are the 4-5 things which institutions can do within their gift. And a lot will get done on the regulatory side over time. We have already seen activism on capital treatment, discussions on adjusting carbon footprint within transactions. Measuring carbon footprint in transactions with respect to trade is another area which is being discussed about. So for instance, if you would measure carbon in a given trade transaction from start to end in each stage of the cycle, you'll be then able to decide whether a particular trade transaction has the level of intensity which you want to finance or no. And I think once we start measuring intensity at transactional level, we will have the ability to then decide whether to finance or not finance, or if finance at what level and at what pricing. Should there be discouragement by pricing or otherwise to be able to then step in or step aside on a given transaction. So these are tools which will get developed over time, and a lot of it is already in the train. But I think each institution, based on its own risk appetite and customer base, has the responsibility to devise their own strategy and be able to transition as much as possible quickly.
You raise a couple of interesting points, and there's always a kind of a creative tension within any institution between those executing the deals, in effect the trade practitioners, and risk management. And in many institutions, ESG comprises part of the risk management. And while it might not be credit risk, there's definitely one of the most feared things within the senior management of any institution, which is reputational risk. And that's where the ESG kind of framework really stands out, because it's the reputational risk of being on the wrong side of financing a transaction that has social implications that go way beyond what the deal was. But in the evaluation of a deal, and you mentioned the way perhaps it be measured in terms of impact, how can it be ensured that a bank is still customer responsive in terms of how quickly they can respond to requests to do a transaction versus running it through the ESG framework?
Yeah, so that's a very, very interesting question, and we were grappling with it earlier in the day because as you would imagine, some of these frameworks are developing. So there are two ways of looking at it. One, are we only financing ESG compliant deals on day one, or are we financing transitions? That's one lens. That do we help clients transition? And the possible answer to this is that we have to support our clients transition, because you can't just switch off one day and say that I've stopped financing X, because that's not good anymore. So then comes the question of how do you look at it for transaction, particularly from a trade finance perspective. Trade finance is a flow business, whereas many of the ESG deals which have been done in the past, for example, in the bond market or others, were event-led businesses or deals which can be looked at in detail, and there is enough time for anybody to prepare. Whereas in trade finance sort of setup, you may actually have transactions which are coming thick and fast, and you may not have the time to run through a massive process for you to be able to evaluate. Therefore, there is a need for us to create some sort of a standardized framework which will enable quick decisioning on ESG transactions, some sort of a screening mechanism, very similar to what we used to have in financial crime and in those areas in the past, Scott, that you referred to. Over time, that kind of framework needs to be developed, particularly for simpler flow transactions within a broader framework. So let's say you have a criteria, and within which, if you submit transaction, they get through a transaction screening process and get processed. And I don't think we have gotten there, because we currently don't have a standardized definition of sustainable trade finance in the industry. So forget coming to, but I think that's the direction of travel. And ICC is also working on developing some definitions, and we are coordinated with them through the BAFT working group as well. The other thing that is mindful here is to, we all need to be mindful, is to work with parties which are credible and be able to use and leverage data from credible sources. So therefore, collaboration with external parties who have expertise and who have the technology and have credible data developed over time in measuring different areas, so be it environmental impact, social impact, is quite critical. And that's where the role of technology comes in, that how do you access this data, who's auditing, what is the second party opinion that is provided in particular areas. That becomes quite critical. So it's a multifaceted sort of problem. One, it requires standardization for flow products. Second, it requires access to technology and data for us to be able to credibly say that, yes, this particular input is valid. And the final thing is to be able to also apply a lens of unintended consequences. So you're doing one thing right, but as a result of doing this right, you're not creating another problem, is the other lens which we need to often employ. And that's where balancing E, S, and G become very, very important.
Thanks. We have a couple of questions from the audience, if I may relay them to you.
Yeah.
The first is, how fast do you think government bodies will regulate ESG?
Well, if you had asked me for 2 years back, I've been close to the subject for some time, and a lot of people told me that this is, discussion is at least 10 years away, particularly on the discussion of capital, stress testing, and others. And I can tell you that the way this has moved in the last 18 months is faster than any other regulatory dialogue or any other given topic. So I think the appetite to work on this is quite high across various regulators, across various topics. Whether we will come out with a stronger regulation in different areas, the answer is yes. But some areas will need evidence-based regulation, which will take more time because this is just getting to develop. But I think the level of regulatory oversight or regulation that you think is coming will surprise all of us, is my short answer. And there is a lot of activity already underway, be it in the EU. You've also seen US regulators, for example, come out and talk about how brown assets should be treated versus green in very recent times, and they have actually come out with a view on that. So there are different views which are developing, and I see this will move faster than any other topics that we have seen in the past.
Kind of going along with that, there was a question: where do you see this framework in 5 years from now?
I think we will definitely have a definition framework in the industry. We are all collectively in it, and we are working towards developing standardized trade definitions. So we will definitely have what is sustainable trade, what is sustainable supply chain finance, how is it to be evaluated, standardized frameworks across institutions. So that will bring a lot of ease and multiplier effect as a result of having standardization. The second thing, what will happen is a lot of private capital. So trade finance as an asset class has historically not attracted a lot of institutional capital for different reasons, because it was not accessible, because it was not investable. It was very bank-led sort of business. But I think with ESG added to the mix, a lot of institutional capital will flow into trade finance because it is real economy by nature, and it offers very good transparent way of investing in ESG. I think that's something that will change very rapidly as we develop the standardization. The other thing that will develop is public-private partnerships. I really think this is the main unlocking lever for us to be able to deliver this, particularly at the deeper end of supply chains and trade finance, if we have to go into developing countries and other areas. And the last, I would say, is the fact that as trade finance practitioners, this will become business as usual for all of us. So this will, I mean, at a very large scale, this will become BAU skill set for many of us, and there will be some specialized people. So like we live and breathe trade finance, UCPs, URCs over years, we will start living and breathing ESG as part of our daily life, because this is not going to be this is going to be the business for us to do. So sustainable trade is the way business will be in future.
It's to my mind, this area is a great area for attraction of fresh, young, bright talent into the banking systems. If you look at, we have the question: how do we attract people into trade? How do we get young people excited about it? And I think there's two areas that offer a lot of promise in terms of attraction of new talent. One of them, and we'll get into this more later, is digitization. And the second is ESG. I think anybody who saw the US Super Bowl, where the halftime show was hip hop, it was a shock to the older generation as to this is the scene. But ESG is now the scene for attraction of bright young minds into the business as well. I got a question, and it kind of pertains to the quantitative issue. Is there any recommended formula at this point in time for calculating carbon footprint in a trade transaction?
So I'm not allowed to name firms here, but there are firms in the market who can actually measure footprint for different transactions. There is no singular firm, because as you would imagine, trade flows are multifaceted. It could be commodity related, it could be service related, and in many other cases, other goods, textiles, autos. So each industry differs. But there are firms in the market who are able to measure footprint at deeper level of transactions. So let's say if it is processing of a metal, then they are able to measure footprint from mining, processing, and then delivering goods to the end customer, including shipping lines, etc. So it is possible to measure trade footprint of certain transactions where there is data available on the shipping lines, on the processing technology, on the growing. And as we grow further, this data will only get enriched. And as we bring together data lakes from different institutions, then we'll be able to do this. So the short answer to your question is yes, it is possible to measure carbon footprint of a given trade transaction, which can then be transposed into various types of decisioning mechanisms, whether to finance, not finance, or otherwise. But at this moment, there's no universal solution that's available. These are all disparate individual solutions which we'll have to build on. And over time, this will get developed into an industry database. And hopefully with definitions, we will have the ability to integrate some of this and have a portfolio view of our portfolios and trade transactions.
Are there fintechs that are specifically working on the issue of the systems needed to incorporate ESG into a bank's overall environment?
Yes, there are. There are a lot of fintechs who are working on white labeled solutions around different areas, be it carbon measurement, be it measuring portfolio risk, climate risk, etc. But you would see two types of institutions. One, large institutions who are working on their own methodology on transforming risk frameworks from looking at risk not just on historical basis but on prospective basis, because ESG risks are not typically historical but more futuristic, and most of our risk models, for example, have been in the past based on historical data, which is not the way it is going to turn out for future. So there is a need for us to look at climate and other risks from a futuristic standpoint. So that's one big piece of work where there are firms who are looking at these scenarios and developing stress scenarios. The other area is measuring and integrating platforms where aggregation is happening. So let's say if there are data providers in different industries, be it auto, textile, FMCG or others, where there are data points related to ESG which get collected, then there are firms in the market who aggregate this information, provide a dashboard view. There are also fintechs and providers who are providing services on deploying supplier assessments across the value chain, developing ESG strategy for the institution themselves. And this is a particularly acute problem in mid-market and commercial, sort of small and medium enterprises. So while the big companies who have the wherewithal and the budgets to develop an ESG strategy or have the resources, in the middle market or the SME space, they may necessarily not have either the resources or the expertise to be able to develop their own ESG strategy and influence their ecosystem. So there are firms in the market who are doing that as well as a service, in addition to providing data and others. So, and therefore there is a need for us to be able to bring these capabilities to the clients, not just ourselves, but by working with these external partners and institutions. And of course, there are governments and public institutions as well which are doing this in different markets.
Okay. How can a bank that doesn't really have an ESG framework, what steps can they take in terms of implementing a program or designing products that focus on ESG?
Well, I mean, we often get this challenge. I mean, even as HSBC, we have clients and work with other banks, and we often get asked this question. I think the first thing one needs to do is to look at peer institutions or institutions in the same industry, because there are lots of institutions which now have stated ESG strategies, the ESG program in place. Even HSBC has a well thought through ESG program for years now. There's also a lot of industry resource available. So you may be aware of the Financial Services Task Force, which is formed under the Net Zero Banking Alliance at COP26, which released a practitioner's handbook on how banks should look at their own pathways for net zero transition, which is one area within sustainability. The other piece is to work with local governments and public institutions to develop these capabilities and capacities. And finally, to borrow or buy technologies if you don't have from external institutions. I named some fintechs and service providers who are able to provide these services to institutions who necessarily don't have their own capabilities. But I would say the first port of call should be to look at peer institutions, and there are lots of resources available from the industry bodies like FSTF or NZBA, or which are providing these pathways for institutions to follow.
Okay. Do you see the possibility of using EUCP, electronic UCP, as a way to support ESG efforts? The comment is being that banks are still heavy in physical documents in international courier packages.
Yeah, so I think more than EUCP, digital trade has a lot of potential, and I touched upon this point in my previous points. That digital and technology has a big role to play, simply because it can create the transparency. And I keep using the example of blockchain, for example. If you had a blockchain-based transaction, where you had nodes exchanging information on different characteristics of the transaction, and that can be securely exchanged and kept between the parties, there is ability to unlock a lot of potential here simply because of the multiplicity of parties involved. So it's not just the buyer, seller, and the bank which is involved now. It's the buyer, seller, the third-party ratings provider, the supplier whose farm is getting assessed, probably a second-party opinion on top of it. So there are multiple providers who are providing these inputs into this chain and enabling the sustainable trade finance transaction for it to happen. And in this context, any digitization effort has a big role to play because it reduces friction and also helps adoption. So I think EUCP or blockchain and Internet of Things have big role to play in industrializing these processes. But I think at this moment, we need to see greater adoption of ESG strategies, products, and solutions. And for it to scale, technology will be the enabler. But we see a big difference right now between developed and developing countries, where the acceptance and the level of maturity of institutions, it varies, and that needs to really change for it to be happening at very large scale.
Okay, I mean, right now, when a financial institution is looking at its ESG framework, it's easier, not simple, but easier reporting on the E. But what about the reporting of S, particularly as it pertains to UN 17 goals?
Yeah, very, very interesting question again. And this is something that we have been tackling. And I did mention balancing the E and S. And I personally believe that balancing E and S are very, very critical. You can't ignore one while addressing the other, because you would be creating another problem for us to solve. Having said that, climate is an emergency. We all have to recognize that, and there is therefore the need to accelerate targeted climate solution, going towards net zero, going towards a 1.5 degrees pathway. These are things which are extremely critical and therefore are more specific. But in the context of developing other solutions, there are various principles that are getting launched. So if you would have seen, LMA has launched social loans principle last year. We are also now seeing within the E various new aspects coming. So apart from the TCFD, which got rolled out now, there is a TNFD, which has got adopted across many players, which is nature-related financial disclosures, which goes a step beyond. So not just addressing the net zero part, but doing initiatives or financing initiatives which are nature positive. So there's a movement from just addressing the climate challenge to moving towards nature positive. There's movement towards addressing just E towards social. And as we go along, there will be more social principles that will get embedded, and standards that are getting developed around social and governance, which will create that ability to report. And some of the reporting aspects around this are also going to get tighter as regulators are looking at disclosures more strongly, both around E and S. And we are expecting that in the coming years, we will have more tighter disclosure requirements around both E and S for us to be able to then tangibly measure progress.
Okay. Regarding reputational risk, is there a movement towards a common way of assessing that risk within an institution?
That's a tough one to answer because reputational risk is a very, very sensitive subject and it could vary across institutions. But there are some common principles that would apply, and I keep using the analogy of financial crime. There are some minimum standards that will get applied across institutions. And then there would be some which will be gold standards, so to say, we're going above and beyond. So I think on the matter of reputational risk on ESG, there are definitely some no-go areas. But going beyond that, for each institution, will have to take their own call on how far can you go, what is practically implementable in your own institution, what is possible to be able to be done when working with other institutions, what is your own risk appetite in your own geography. Because a lot of work that financial institutions do also get driven by the local regulatory requirements. So if you cannot change it, then it's impossible for you to address some of the areas. So it's difficult to have a common standard, particularly when it comes to reputational risk. But I would think instead of common standard, there would be some minimum standards that will come in, which would then be supplemented by individual ambitions of institutions.
Okay. Question. I think we have time for one more here before our time runs out. And the proposition is that businesses tend to focus on corporate profits, and business don't normally see things in their enlightened self-interest unless there is some government pressure to recognize the social responsibility. Which banks, of course, yours would be included, but which banks do you think have been successful in encouraging their corporate clients to understand the operation of an ESG framework?
I would not get drawn into the attraction of naming institutions here because it would be appropriate for me.
Okay.
But, I would say that there are several institutions now, and I can definitely speak about successes that HSBC has had in terms of helping our clients or working with our clients, let's say, in developing ESG. So we have had examples of supporting companies in developing markets, sourcing commodities, companies sourcing building green buildings, supporting causes of social and diversity inclusion. I took the example previously. There are multiple examples where we have worked with clients. I think what stands out in all these examples is the fact that now the awareness is not just within the large corporates, but also within the mid-market and SMEs, who don't necessarily have the expertise, but have the willingness to invest and co-create with you. And we have had successes in that space in all the developing markets that we operate. But the key thing here is that the anchor corporate, which is the big corporate, for instance, in a supply chain scenario, also has a big role to play. So it is the big multinational giants of the world who have the responsibility to take their ecosystem along while they develop their own ESG strategy, making sure that their suppliers and buyers are also walking with them and sharing their expertise and resources to be able to transition them. And we have seen some very good examples with Walmart, I named already. We've done a program for Puma as well, where we have seen similar success. We've worked with Asian Development Bank in working with our clients on supporting with public-private partnership efforts. So there are several industry examples that are there, which are in public domain, where we have really driven ESG solutions with the client, and not just for one institution, but for multiple institutions together.
Thanks. It's been a great enlightening session. I really appreciate your time, and you've got some heavy lifting to do in the future. So good luck to you.
Thank you.